runs to clear the original consolidation for that liquidity. This pattern, if you haven't already noticed, and I should have mentioned this on the previous slide talking about the market maker sell model, but it's interchangeable. Everything is reversed in terms of the logic. But this could be a weekly profile. This could be an intraday profile. This could be a monthly profile. So in other words, all these price swings are fractal. But the expectation of what is it doing? It's consolidating here to go down. Why is it going to go down? It's going to go down to go higher. That's narrative. Going in a consolidation, breaking, retracing back here. Is it retracing here to go higher than this? Or is it retracing just to go short? It's retracing just to go short. So that's distribution. First stage distribution. Second stage distribution. So when we get down to this level here, we're looking for a point at which price basically proves to us that it wants to go higher. And that'll take place in the form of a short-term market structure shift. And you can utilize what I've taught on the YouTube channel model for that to make it very simple and simplistic. Then we wait for evidence that shows us that it wants to go higher. So every time there's a point of up candles on the sell side of the curve, that means the lowest point to the left. Here is a point at which there's up close candles, or what would be expected as up close candles, prior to that move lower. Same thing here. Up close candles somewhere in this price swing. We carry them across the curve. That means this turning point here. This level here, we carry that through the curve as well. So we're looking for a retracing back down into an old area distribution becomes a new level of accumulation. So first stage accumulation is here. You could be a buyer. And the second stage reaccumulation, that's where the most dynamic price move is going to occur. And then it rallies. So I'm looking for this phenomenon to occur in every time frame I'm looking at. If I can find it, and it fits the narrative of why I think price should be doing what it's doing, and it fits a bias that I feel comfortable with trading with a higher time frame bias behind me, and it's time of day and day of week, and it's maybe even a seasonal tendency, not that you have to have that, but that even helps a lot more, then it gives me the confidence to be able to take the trades. And like, I get a lot of questions still by members from the 2016 group. How do I know to trust the fair value gap? Well, it has to fit this kind of logic here. And if I get a fair value gap in here that overlaps with a old area of distribution, I'm going to trust that fair value gap isn't going to be broken to the downside and just break lower. If it does, that's okay. I'm paying a stop loss to do its job. Same thing over here. If I see an old area of distribution now becoming an old area of distribution, now reaccumulation, that is an area I'm going to trust because I have the narrative that we're likely to go above these highs. We went down to go up. We showed a shift in market structure. We showed accumulation in here. Now we're in the area where it should reaccumulate. So if there's a fair value gap in here, or institutional order flow entry drill, I'm going to take that trade with the expectation that I don't think it's going to close in the gap and overlap it and go lower, in other words. So I'm trusting it because I have other confluences behind me. So I'm not going into the marketplace with just one of these ideas that I'm teaching you, and that's all there is to it. That's not what I want you to view in my interpretation of price action. I don't want you to make a model out of one thing. Just a fair value gap alone is useless in the hands of a neophyte. So you have to have all these things behind you. And if you just look at the comments in my Twitter or my YouTube channel, the folks that are just now trying to learn how to do this, they're rushing to go in there and trade with live funds. They're making mistakes because I thought I saw this fair value gap here, or they'll send me a message and they want me to more or less co-sign their trade. That was always the case even in the mentorship groups here. People would always send me emails, and they largely would go ignored because they want me to give them a seal of approval. I don't have time to sit down and look at everybody's emails, number one. Two, if I tell you or if I give anybody else feedback about their trade, it's not their trade, it's my trade. And you're not going to learn anything except for codependence. So you have to go through the process, and it's not easy. This is the hard part, the work of going through when it doesn't feel like you're ever going to get. That's the normal process with anything that's technical. Anything worth having or knowing is always going to come with a great deal of hardship and, well, adversities. But it's worth it, folks. It really is worth it. And times are about to get really, really difficult. And if you can find yourself in a position where you can at least make half of what you normally make at your job, if not replace the entire income, that is going to be a blessing. But you don't want to put all of your expectations on one individual thing that I taught you, like a fair value gap or an order block or an optimal trade entry or institutional order flow entry drill. You're hopefully doing the work behind the scenes and looking for this overall price structure here, but focusing on the buy side of the curve when it's a market maker sell model, and it should have gone down to these levels here to go higher anyway. That's narrative. In other words, it's going down, digging in deeper. It creates a short-term low, starts to rally, so that way what? Retail will want to buy it. It goes down a little bit lower, stops those individuals out, and then starts to do it one more time. And they think, okay, I was wrong. I was a little bit premature. Let me go and buy it again. And they put their stop loss right below here, and then they run it out again. Then goes into the level that we would be expecting. This could be a larger, higher time frame fair value gap. It could be an order block. It could be a breaker, okay? Or it could be just simply an old high being returned back into. And those ideas are going to be linked to your unique model. There's, like I said, there's tons and tons of trade ideas and opportunities each month and each week, and several of them intraday. And even though you're all learning these concepts collectively as a community, you're going to be hard pressed to find, a dozen traders doing the same thing at the same entry price, same stop level, same target, because they're bringing in their individual personality. But these things I'm showing you, these are the blueprints. These are the framework in which you look for the setups and justify why you're doing and anticipating price doing a specific thing. And if it doesn't fit this criteria here, then chances are you probably are doing something that's forced, or it's simply not in the market. And if the market starts to move from the level we expect down here, and we expect it to run up here as a target above the original consolidation, if that's the case, and we have one price run up above 50% of that range between the high and the low here, and it starts to retrace, then I'm thinking we're only going to have one stage of accumulation. So I can't do any pyramiding here. But if I have one here and it goes about halfway or a little bit less and pulls back down in, then I know I have a chance to pyramid. So I can do a long here, say maybe 10 contracts of the S&P. Then I can do 5 here. And if it gives me some kind of little institutional order flow entry drill here, right before it runs out the highs, and I think it's going to be moving higher, not just here, then I could add another 2 contracts. So it'd be 10, 5, and 2, or 10, 5, and 3. Something to that effect, okay? And that's pretty much what I'm doing. Like, I'm going through the process of looking for this structure in price that meets and agrees with the narrative I'm expecting for price for that particular session or that particular day or that particular week, okay? Because these profiles, these market maker buy models and sell models, they're not limited to any one particular time frame. But the logic behind them, and when you're looking for specific things of accumulation or distribution, they have to meet what I explained, and it's not Wyckoff, okay? It is very specific elements that have to balance themselves out based on what side of the curve price is on. All right, in the S&P, again, same thing this morning. This is a chart I shared on my Twitter feed beforehand. I mentioned that we would see these stops here taken, and once it was cleared out, we would expect price to, and I would rather expect to see price trade above the 41.43.5. So buy side resting over here. If you looked at the first example I showed in this algorithmic discussion, this was the first stage of accumulation, second stage accumulation, and then it hits the premium array, okay, which is the old high back here. It went just above the gray line here. That's what it's doing. Now this becomes an area of buy side liquidity after the market breaks down. Notice there is no real retracements for first stage or second stage distribution. So because of that, this decline down here was just them running out sell side, and then they gave one more instance where they created a low. Anybody was long, they knocked those individuals out because they engineered liquidity. Then it started to rally. We had a fair value gap in here, rallied, fair value gap here, rallied, went back into the last fair value gap here, and then dropped to an area of sell side. What is this? What's this right here? That's an original consolidation that's below the buy side here. So when I was watching price, I'm looking at this as, okay, this is a market maker buy model. So I want to be buying on the buy side of the curve. That means it's got to turn around. So I'm waiting. Admittedly, I bought early over here, and I had to weather this. My stop was not touched, obviously, but as it dropped down, I could have easily had a losing trade, but the logic was still there. The market went down, cleared out that level again, and then got to this price point here. And I tweeted this chart. I said, this is where I think it's going to go. And there it is. Now we're ready to go higher because we've taken the sell side out. So smart money has accumulated down here, all the sell stops. Where do they want to get out at? Above here, where I took a partial, and above here, where the buy side liquidity is. So in this little fractal here, I'm expecting a market maker buy model to form. So here is the 1 minute chart, and we're looking at that same consolidation and the old high that I think is going to be taken out on buy side. And the market has this area of old distribution becomes a new level of accumulation over here. So here's the curve, sell side of the curve here. To the right of it is the buy side of the curve. Smart money reversal, low risk buy, accumulation, reaccumulation, second stage, and then you see the extrapolated price run. So the buy side is targeted there. The original consolidation is here. So we have initial draw here and then here. First stage accumulation, second stage reaccumulation. That swing low sets the stage for that dynamic price run. All the energy is there on the second one, and it runs us up into here and here. And I basically outlined this whole thing with a simple discussion with what I expected on Twitter, without going through the mechanics of everything I'm showing you here. Now, more specific, we can drop down to a 15-second chart, which I had available to me, and I'm not going to share this, obviously, because it would be teaching mentorship on Twitter, and I'm not doing that. But here's the original consolidation. Up close candle, carry that through to the buy side of the curve. You can see it drops down into that for second stage accumulation. Up close candles, carry that through to buy side of the curve. You can see we went down into that and accumulated again. So we have first stage accumulation, could be a buyer there. Second stage accumulation, that's the one that has the most dynamic price run, and you can see it there. So everything that I'm teaching you, if you have the idea of where the market's going to draw to, okay, which is why I always preach this all the time. This is the most important thing. It's not the entry points, okay? It's not. It's knowing where the market's going to go, because if you can have that idea and be correct about it most times, and you're able to look for this pattern, you will be able to trade every time frame, whether it's a 15-second chart, 1 minute chart, 5 minute chart, 15-minute chart, hourly chart, 2-hour chart, 4-hour chart, 90-minute chart, daily chart, weekly chart, monthly chart, quarterly chart. You get what I'm saying, right? I'm being obnoxious now. But the point is, you're going to be completely unshackled. You're going to have no limits, none. And you'll be able to trade every time frame in every fractal. Now, that is not an invitation to go out there and try to trade like a madman, okay? You have to have some kind of discipline. But knowing what you're looking for and blending the things that you've been taught here, that is how you get the results. You can't just take one thing on the basis of just that one thing. You have to have confluences. And the experience factor will grow as you do it more and more. And do not be afraid or discouraged if you get it wrong. Because when you get it wrong, that's where you're learning. Don't look at doing things wrong while you're developing as failure. That's where you learn. You have to understand that that's a moment for you to understand more than you did before you did that exercise or that paper trade or whatever it is you did that you concede as a failure. When it's not failure, that's a growth pain. And growing pains is part of all this stuff. Okay? So if you found this one insightful, until I talk to you next time, be safe.